All right. Good morning, good afternoon, traders. Today is Wednesday, January 14th, 2026. This is You've Got Options for Income Navigator. And today we're going to start off by looking at the daily chart of the VIX. If you are in the market in any way, shape, or form, you probably noticed that in the last couple of days, the VIX has been climbing higher. And today it's obviously higher than last couple of days. And talk about the VIX. The VIX tells us about the demand for SPX or S&P 500 options, right? When the market participants reach for insurance protection, right? They are going to pay more for out of the money options. Therefore, market makers have to adjust the prices. They have to raise implied volatility. And as a result, we are seeing higher VIX in the last couple of days. But more importantly, one thing I mentioned earlier today, one chart I was looking at, and this is something I pointed out yesterday, right? This bar here is yesterday's price action in VVIX, which is the VIX for the VIX. Now, the market participants can hedge in one of two ways. They can, well, maybe more than two ways, but one of several ways they can hedge is by right, get out of their positions. That's probably the easiest. Number two, they can buy puts, right? And they can go out and buy puts 30 days. They can buy puts 60 days. Now SPX has daily expirations. They can buy short-term puts. They can buy longer-term puts. They can also, right, if the market participants are hedging from a market move to the downside, they would go out and buy puts on the S&P 500. Now, if they're expecting the market to become more volatile, meaning they don't know if the market's going to go up or the market's going to go down, but they are hedging against future volatility, they'll go out and buy VIX options. When the demand for VIX options goes up, this shows up on the chart of VVIX. I also posted earlier today on Discord. This was today's. Hang on one second. Maybe I can share this with you guys. This was today's option statistics for VIX, where we saw the number of calls traded versus the number of puts. Even right now, the VIX options have 720,000 contracts, right? 720,000 calls traded with about 257,000 puts traded, meaning that calls are almost 3-to-1 more active than the puts. So the market participants are buying up calls, right? They are anticipating more volatility in the VIX going forward. Does this mean that, the market's going to roll over and die here? I don't know, and I don't think so, because if we look at the VIX, and this is 2025 to current, right? We saw a big spike in VIX in April, right? So this chart is a little skewed, but if we zoom out just a little bit, and this last major spike in the VIX was August of 2024, but if we just ignore the last two big spikes, right? Normally, right, the VIX goes up and then the VIX comes down. VIX goes up and comes down, and it kind of trades in a range, right? And we could identify the high end of the range and the low end of that same range. Sure, there are times where these ranges are wider and there are times when these ranges are narrower. But if we look at the context of what's happening, right, the VIX is just now starting to come off of extremely low levels, right? These extremely low levels in VIX were associated with, well, we just had end of the year, which is historically very not volatile time of the year, right? So the market was kind of muted. And the VIX was trading at around 14 or so. Now we're trading, the VIX is at around 17, right? Is the market implying right now, or is the VIX implying right now that the market's going to crash here? Right, the market is not very nervous. We're just reverting back to the mean. If you look at historic average price of VIX, it's at around 18. Right, so the VIX is rising. You might also have noticed that in the last couple of days, right, the market didn't really move a whole lot. And I'm talking about, SPX. Look at SPX. Sure, we're down, right? But how much are we down from recent highs, right? I think this was Monday the 12th when SPX hit a new all-time high. And from Monday's high to today's low, we're down 1.5%, which is not a lot. But you might have noticed your P&L in the last couple of days, right? You're at a bigger drawdown than you would expect to have with the market being down 1.5%. And that is primarily due to a rise in implied volatility or the VIX. So yes, there are going to be times where we go from extremely low volatility environment, right, to back to normal, right? I think that VIX at 17 is normal, right? So when volatility reverts back to the mean, and if you were already heavily invested at super extreme or super low volatility levels, when volatility reverts back to the mean, it isn't going to feel all that great, right? But all in all, if we look at just the market structure, right, we're in a pretty steady uprising market. We're still making higher highs, and we're still potentially making a higher low. Right, the confirmation here is going to be how we trade if we get down to around the lows that were literally December 30th, December 31st. Now, if we take out the previous swing lows, right, and then there's no follow through, and we see a move back up, and we don't take out the most recent high, which is also an all-time high, right? We can make the case that this trend is now in question, right? This trend is now changing. We don't go from uptrend to downtrend unless there's some headlines and the market is very sensitive and driven by the headlines. But there could be a case to be made that we may be going into a phase where the market is going to consolidate for some time until we build up enough energy for the market to continue either higher or lower. Right? So if you think the market's going to roll over and die here, I don't think there is any indication. Now, sure, if we're down, 5% tomorrow, right? That's going to be a great call. Like if you're in a camp where you're calling for the market to crash every single day, eventually you might be right. Right? But as of right now, there's really nothing in the charts that is suggesting that the market is rolling over here. Right? Even with the market down today, we're down about, what's this? Just about 1%, just shy of 1%. If we go back and look at the VIX, right? VIX closed yesterday at 1597. Now, I know we talked about this before, but VIX at 1957, at 1597, right? Let's round this off. VIX at 16. What does that mean? What kind of a move is expected on a day-to-day basis with VIX at 16? If you frequent these meetings and if you participate in the Discord, you probably heard us say that VIX at 16 implies a one-day move of up or down 1%. Yes, Benjamin, you're right. The market is implying a 1 day move of 1%. It could be up or down when VIX is at 16. If the VIX is at 32, using the same rule of 16. If the VIX is at 32, that means the market is implying a move of either up or down 2% on any given day. So SPY being down 1% today and the VIX closing out yesterday at 16, are we outside of what was being priced in headed into today? So far, the answer is no, right? So we're not moving with more speed than what the market was already anticipating based on yesterday's reading in the VIX. Now, today, the VIX is higher, which means that whoever bought protection yesterday, right, this was not enough. And the VIX is moving with almost the same speed as was what was being priced in, right? So now the market participants that are thinking that the market is, or the SPX or SPY, S&P 500 is going to continue to move with at least what is being priced in or greater, they may have to go out and buy more protection. And that's causing the VIX to rise some more. And now with the VIX at 1763, we would assume that for the next trading day, we are anticipating a move up or down 1.1%. So if the market is down, right, 0.8% tomorrow, the VIX may actually go down a little because we're not moving with the kind of speed that the market is anticipating. Right? So we're not guessing here. Is the market going up or down tomorrow? We're just trying to get an understanding of what the market participants are implying, or what is the VIX telling us about anticipation going forward, right? What kind of volatility should we expect going forward? So it would be fair to say that if the market moves up or down 1%, it is justified based on current VIX readings. You can look at, some sectors and understand what's driving the market, right? Financials are, I think, about a 15% weight on SPY, right? The news that current administration is trying to put a cap on how much credit card companies are allowed to charge an interest for a year. I think they're trying to cap it at 10%, right? That potentially could hurt credit card companies. If you look at MasterCard, for example, was down yesterday, and just overall, XLF is under pressure last couple of days. We can also look at XLY, right? This is consumer discretionary. And then we can look at XLP. These are staples. And you can see that staples are up today, even though the market is down. So you can make the case that even though the market is down, right? The market is down, but you can look at two sectors that technically kind of moving in opposites, right? You have the staples, such as your toothpaste, your, soda, your cigarettes, whatever continues to be bought regardless of the economy up or down. And then you have the discretionaries. The money is rotating out of discretionaries and into staples, right? And then if you wanted to look at this is something that I pointed out earlier today. And again, just to get some sort of context around what's happening, right? We'll look at the tick readings. Are we seeing major? I don't think this is what I wanted to look at. Let me switch over to a different chart. And right, looking at the tick readings, we're not seeing negative 800, negative 1000 tick readings, right? Suggesting that it is selling all across the board. Today's lowest tick was negative 751, right? So I think we could make the case here that what we're seeing right now is not necessarily selling pressure. We're just seeing lack of buying pressure, right? Lack of buyings. We can make the case that the buyers are on strike right now, and there's really no good reason to go out and take on a ton of risk with a couple of unknowns, right? Supreme Court needs to, or they're going to make a decision on the tariffs at some point. It was supposed to be today. Apparently, it isn't. They're not going to make that decision today. So the market's kind of taking a breather, but it is still hanging over our heads, and we don't know how they're going to rule. Right? So if you are a risk manager, or you're going to go out and take on a ton of risk with that unknown, it's a known unknown. So we know it's coming. We don't know when, and we don't know what the outcome, but we know it's out there, right? So the market is kind of cautious right now. And that is the reason why we're seeing rotation out of discretionary into staples. Right. So that's just kind of the way I look at the markets. And, you can always find pockets of strength. We talked last week about Costco, right? And it continues to move higher. It continues to move higher. The idea that I talked about was buying some sort of a stock replacement. I mean, if you want to go out and buy a $950 stock, that's totally fine. If you don't want to commit that kind of capital, there are other ways that we could take advantage of leverage, as long as we do it, and we're responsible about it. We can go out and buy leaps. We can buy in the money leaps. We can also go out and sell an at the money put, buy an at the money call, which will be a synthetic long stock position. You can buy a protective put with that as well, right? But if we combine an at the money short put and at the money long call with a protective put, all of that combined will be equivalent to just going out and buying an in the money leap. Right, so those two will have the same exact risk profile, and they will both have, I believe they will be both pretty close in capital requirements. How much settled cash you would have to commit to put the trade on. And then you can sell short-term upside calls against your synthetic long stock position to work off your cost basis, right? As long as, right, you are keeping an eye on your short near-term call position and make adjustments when necessary. Right? We can look at a couple of others. So I have a position in Amazon, which is very similar, and I'll tell you what I'm doing with it and what I was looking at. Right? So what I did was I put on a position on a breakout of this range that, Amazon has been in this range for quite some time. There was one failed attempt with a quick reversal and a move back inside of the range. Now we saw another, what looks like now a failed break out of this range with a pullback, right? Looks like we're getting back inside of this range, which is not a big deal, right? I still think this is neutral to slightly bullish longer term. If we trade outside of this range to the downside, I would be a little bit more concerned, right? But for right here, I think, right, the market will very often trade in the range. It'll break out a couple of times. It'll trap some people in, and then it'll punish them, right? If you're over leveraged, if you're oversized, right, swinging for the fence on this breakout, and then the market or whatever the underlying is, right, it comes back inside of the range, odds are you're getting smoked on whatever you bought on this breakout. So you have to sell whatever you bought, right? It kind of doing the same thing here yet again, right? It's testing this, what was resistance now could potentially become support. So that's why I'm not totally, giving up on this trade. But my trade in Amazon, let me see if I can pull this up and show you what I'm doing. And I'm going to share a different screen with you. All right. So this is my dog in Amazon. It is down, right? I'm in this trade for 7 days. In the last 7 days, the underlying has moved down 0.8 of one standard deviation. Implied volatility is up a little bit. The way I am playing this Amazon trade is I am long January 2027, 170 call. Stock is at 237. So as you can see, this 170 call is an in the money leap with just about 365 days or a little bit more out until expiration. And I am short Feb 6th, 255 calls against this position, which is you can call this a poor man's covered call. You wouldn't be wrong. You can also call this a long call diagonal spread. That's not wrong as well, right? But now you kind of want to think about this position in several moving parts at the same time, right? So we have the long leap in play. We have the long leap in play. That's my long-term bullish position. And then I'm selling near-term calls against this leap, right? What I like to do, right? So I'm long 2 leaps and I'm short 2 calls. What I like to do, sometimes I like to overwrite, and I would sell more contracts than I would sell more near-term contracts than I have longer-term contracts. So if I'm long 2 leaps, I would sell 2, maybe 3 or 4 short-term calls. But then this kind of position requires, it does require some maintenance, as in, if the underlying is moving, I don't want to let my short calls go too deep in the money, because making adjustments just become a little bit too expensive to compensate. I'm forced to move too many things around. So at the same time, what I'm looking at with this kind of a position, I'm looking at my net delta, and that tells me everything I need to know. Right? You could also look at your net P&L, and you wouldn't be wrong if you have some dollar amount which should represent some X% of your overall portfolio. Right? So if you're looking at the P&L as in where is my stop, that's one right way to go about this. But you also want to keep an eye on your net delta and understand, right, what's your longer term outlook? Are you still bullish in the price of the underlying longer term? If yes, then these near term pullbacks could potentially be just an opportunity, right? I was short the 255 for $6.69. They're currently trading for $3.75, right? So they've lost, maybe 40% or whatever of their value. Would I be wrong to take it off here right now to buy those back for about a 40% gain? It's not wrong, right? That's one way to do it. But what does that do? That's going to increase my net delta from plus 121 to plus 174. Do I want to hold plus 174 delta right now? Looking at the chart, and again, there's no right or wrong. If you can time the market, the better you are at timing the market, the better off you are with making these kind of incremental adjustments along the way, right? Amazon is now testing the 21 EMA. We're below the 8 EMA and we're above the 50 EMA. So could I say that we're still bullish? We kind of are, but again, we're coming back into this chop, right? So do I know or do I think that Amazon's going higher from here? I don't. That's why I'm not in a rush to get rid of these calls just yet. I'm going to continue to hold. Now, if I'm concerned that this pullback is going to be towards lower end of this range, which could be around maybe 225, 220. If I wanted to remove some of the potential drawdown, right? If we are going to go towards towards 225, right? I can delta hedge my position near term. How would I do that? Right, if I'm long 120 delta, which is equivalent to being long 120 shares of Amazon right now, well, one way to do it, let's say I wanted to remove 1/3 of my net position, right? So from 120, I wanted to remove about 40 delta. I'll go out and short 40 shares, right? Shorting 40 shares will take my delta from 121 to about 81. And you can see my adjusted or my new risk graph, right? It's still going to lean bullish, but I'm going to lose less dollars per 1 point move if we are in fact going to go down towards 225. All right, that's one way to do it. I'm giving up some potential upside profit in exchange for a slightly smoother T+0 line on the way down. I can short the shares. Right now, we're thinking like market makers. We're not panicking. We're not freaking out about this. Right? We're not closing our position, and we look at our net delta and trying to figure out. First, we need to identify what kind of exposure we want to hold on to. Right? And then we're going to try to figure out what is the path of least resistance to get there. What are we going to do? Are we going to short the shares? If our outlook on implied volatility was, let's say we're bearish implied volatility, which we probably shouldn't be because we know earnings are coming up. And this is to Michael that's asking concern for Amazon earnings just before the short strike expiration. Sure, earnings risk is definitely there. So if you don't want to hold on over earnings and risk it, maybe you wanted to neutralize or cut your position as close to delta neutral as possible, or this definitely needs something that needed to be thought about before this position was put on. And if you don't want to take on directional risk heading into earnings, then this entire trade shouldn't have been put on. But if we're here now and we're just trying to maybe reduce our directional exposure heading into earnings, so maybe we want to take off half of this position, right, without closing out the leap. And what we're going to do is we're going to move, right? We can possibly move the short 255s down to closer at the money, right, and slightly overwrite, right? So selling 3 235s, which are just about 2 points in the money, but it'll cut my delta from positive 120, right? It's like having long 120 shares to delta of 6, which is equivalent to being long 6 shares of Amazon. Do I care if Amazon is up or down $10 tomorrow? If I'm long 5 or 6 delta? My answer is no. Right? If I don't want to be this neutral and I say, you know what, I don't want to have 120 shares of Amazon, but I definitely don't want to have a delta neutral position. I want to be slightly bullish, then maybe we'll move up. And now we have positive 30 delta. So we go from 6 shares to 30 shares, right? We're leaning a little bit more bullish in this position. So there are definitely many ways that a trade, which is in a nutshell, this is a long-term bullish trade. Why? because we are long. Let me get rid of all this. We are long, or I am long here, the January 2027 170 call, which is in the money. That's my long-term play. What I'm talking about here now is a way or several ways that we can possibly use near-term price action to, one, reduce our cost basis, right? Because selling the two of the 255 calls, I reduced my cost basis by about, and I call this 12 or 1300 bucks, right? And then if I go out and maybe sell another, maybe not two, one, sell one 235 call, which is slightly in the money, right? I will have collected another $1,100, and I made a mistake earlier when I said that I reduced my cost basis by $1,300. I didn't. Well, actually, I did. I collected $669 for each one of these 255s, and I sold two of them. So yeah, I collected about $1,300. But if I sell one more 235 call right now for 1150, I will bring in another $1,150. I will also reduce my delta in half. I'll have half of the bullish exposure, and I could hold on through earnings with less potential P&L volatility if the reaction to earnings is going to be to the downside. What is the price, or what's the cost of all of this? The cost is that if I reduce my delta here now and the reaction after earnings is to the upside, right? If Amazon breaks out to all-time high, well, my position is going to go from 65 positive deltas. I will lose all of my positive delta above 255, right? At 255, you can see my delta will turn negative, which means for every 1 point going higher, right, instead of making money in this position, I will be actually losing money because my delta will flip negative. So if I'm going to make this adjustment here now, I need to be aware that there is upside risk. And if Amazon trades higher, I will need to react. I can't wait. I mean, I can wait and look for a pullback, but if Amazon breaks out to all-time highs, I think there could potentially be more upside. And as you can see, the higher it goes, right, the more upside risk we have. So these kind of adjustments, we need to have sort of a plan for future adjustments, right? If we're going to cut near term, short term, for the next 23 days, if we cut delta, right, to kind of mitigate some of that potential losses, if we're concerned about earnings, right, that's the positive. That this is what we get. But what do we have to give up for it? How do we pay for that? We pay for it by taking on upside risk. And if we're wrong about our anticipation of a downside move, if the move is actually to the upside, we're going to pay for it with our P&L. And, this isn't the end of the world, because what's going to happen here is, let's just say that, earnings are out. And I think earnings are in 15 days. Earnings are out in 15 days. So what's going to happen is, in about 20 days from now, let's go to T plus 20. If the reaction is to the upside, but not more than what is currently being implied, even after we make this adjustment, we are going to see volatility crush on the short end of the curve, or in the near term options. You can see that implied volatility for options with 23 days are at 43%. And if we go out a little bit farther out in time, right, options with 184 days implied volatility is at 34%. So near-term implied volatility is higher, and that's due to the event that's coming up, which is the earnings announcement. And we know that regardless of the number, good or bad, or once the earnings are out, a lot of this implied volatility, a lot of this hot air is going to come out. So if the reaction is to the upside, but we don't exceed what is currently being priced in, right, we could end up in this profit zone, which is not a terrible place to be. Yes, our 235 is going to be in the money, right? But our 255s will have lost most of their premium because we will have only 3 days left until expiration. And our the 170 leap, right, is going to increase in value because the underlying could potentially move from 235 up to 250 or 255. Right, so that's kind of my thinking. Did I make an adjustment in this trade? No. I didn't adjust. I tried to make an adjustment last couple of days, and I wasn't in a rush to do anything. So if I didn't get a fill, I just leave it alone. In hindsight, sure, going after some sort of a delta hedge when we were pushing, through 247 or whatever we were, just on Monday, would have been the right idea, right? We were up here. And you can see, what did this trade look like back on, just 2 days ago? Right? 2 days ago, this trade looked much better. But now we're at a slight drawdown, right? The underlying is moving lower. We have earnings coming up, and now we need to decide, do we want to hold on to 122 delta? If the answer is yes, then we do nothing. If we're concerned about more downside, if we're concerned that we're going back into this trading range and we potentially are going to retest 225, then we don't want to have as much positive delta, and we just need to maybe reduce our delta in half. At least that's the general idea. This is not the rule. This is not a law. This is a guideline, right? If you think even cutting delta in half isn't enough, well, you can cut more, or right, you can sell a little bit more contracts at slightly higher prices, but then you also just have to be aware that by giving yourself a little bit more room to the downside, right? This is the gimme. And where's the gotcha? We're introducing this upside risk, which is the potential cost for a little bit less pain on the downside, right? There's always a balance that you need to try to figure out what works best for you. We can use, cut delta in half as a rule of thumb. It's not a terrible starting point, right? And if that's not enough, then you cut some more. Shorting shares here right now, if I sold 50 shares short, right, and took my delta from 120 to about 70, it's not terrible. The problem is that shorting shares, the delta, the negative 50 delta that comes into play from short stock position is going to remain constant. If I'm selling instead of, and this is a good exercise, and if we compare the two risk graphs, right, selling 50 shares short against this entire position will cut my delta from 120 to plus 70. Right, and then I don't lose my positive delta until about 265, or I can replace the short stock position with just shorting one at the money shorting one at the money call, which is also a negative 50 delta move, right? My delta goes from 123 to about 67 or 68. I will lose my delta a little bit sooner, right? My delta will flip negative at about 255. But then I think the amount of potential profit in the tent is a little bit higher if we were to short a 235 call instead of shorting 50 shares. And we can actually compare the two. This is a really good exercise, and just to understand, it's definitely it's way harder to imagine this in your head, right? So you can take a screenshot and then compare the two. Compare the Greeks, compare the benefits, and what is the risk of this benefit, right? So I'm just comparing the two risk graphs, shorting 50 shares against the leap or this poor man's covered call, or selling one at the money or slightly in the money call, right? Which will give me about the same directional exposure. And now comparing the two risk graphs, at 255 is where we max out on the short 50 share position. And that is about right in line with shorting 235 call, except at 235, shorting the 235 at expiration will still make money, whereas here with this with being short 50 share position at 235, we're actually going to be at a loss of about $500. So far, selling an at the money or slightly in the money call is a better option than shorting 50 shares against the poor man's covered call position. Now I'm just comparing the potential upside break evens, and shorting 50 shares puts my upside break even to about 287 or so, and selling an at the money call puts my upside break even at about 273. So there's about a slight difference, right? Shorting shares gives us a little bit more room to the upside. And we're maxing out on both positions at around a potentially $2,000 profit if we were to pin 255 on February 6th, whether you're short 50 shares or short one at the money call. Both trades have max potential profit at around $2,000 if we were to be square at 255 at expiration. Right, so I'm not making the case that one is better than the other. We're just comparing the two, and while one may look better to me, you might disagree and figure out that the other adjustment works better for you because you might have something else on where blah, 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 for whatever reason, right? But the thought process is what's important here, right? How do you go about thinking about these kind of trades? How would you adjust it? How would you compare the two? And then figure out which adjustment will work best for you. Right? So that's kind of my thought process about this Amazon trade. I'm just looking to see if there are any questions here on this chat. Time allowing, could you briefly touch on synthetic short on stocks? Shorting stocks? Why would you want to short stocks? The market only goes up. Why would you want to short stocks? If you want to do a synthetic short, synthetic shorts on stocks, especially, I think it's just very dangerous because you have to be aware of the risks to the upside. Um, for example, if you wanted to short SPY, it's not that big a deal, right? SPY is not going to get bought out at a 50% premium, right? But if you're doing some kind of an individual company that could potentially get bought out at a massive premium, you get trapped in your short. If you're just flat out shorting stock, you can have a problem having to buy the stock back. But if you are doing some kind of synthetic short, utilizing margin, that margin could blow up and cause a lot more damage than you could potentially assume if you don't account for potential margin expansion. Let's say this is strategy 2 or 3 months ago. Okay. Let's have a look. And, strategy is also one of those companies that we're not sure what they're doing other than just holding a bunch of Bitcoin. And, you know, looking at strategy, let me, it all goes back to the chart. I don't think that strategy is going to get bought out, but, if Bitcoin does something ridiculous, or if they come up with some new scheme, right, how to acquire even more Bitcoin without having to pay anybody anything, right? Look at these moves, right? I'm not saying this is coming, but if you thought, oh, this thing is just going to drift lower over time, right? You get these big reversals. And if we just measure these moves, right, you got a 75% move to the upside in just 29 trading days. Again, I know that I'm not answering your question, but we'll look at it. But I'm just saying that I think, and this is what everyone should do, is think about the risk first before you think why MicroStrategy is going to zero, before you think why their business model sucks and everything else, right? Think about the risk. It has done it before, and you cannot rule out that this is never going to happen again. Right? We've seen these kind of 140% move in 16 trading days. That's 3 weeks. Right? So if you get caught short, you have to understand right. Maybe you have a long-term idea that, this stock sucks and it's going to go to zero. Okay. But if you structure risk wrong, if you structure your risk the wrong way, and you don't account for potential margin expansion, if you're out of margin, yes, you may be right on your idea long term, but if you're out of margin and you have to meet the call, you have to get out of your position at the worst possible time. So if you have an idea, make sure that you have the margin, because synthetic short does not take a lot of money up front, but should things start to get really heavy, you might find yourself in a position where you have to put up more margin. And if you don't have it, you have to force liquidate. It usually happens at the worst possible time. But anyways, we can look at a short position in strategy. Yeah, if Benjamin, VXX is just a slightly different animal, and yeah, I think VXX, this everything I just said applies to VXX short as well, because it could potentially go from 30 to 90, which we have seen happen before, and you need to kind of anticipate how much margin will it take to hold your position with the underlying trading at whatever level it may go to. right? Your margin can balloon, and you kind of have to have that in reserves, because if you don't and you're forced to liquidate your position, well, guess what? Covering short VXX at 90 could potentially be game over, right? So shorts are kind of tough, and I think that you can buy a call, a protective call, right? So kind of instead of buying a downside protective put, if you're a long, synthetic long, a position, you can buy a, you can possibly buy a near-term call to kind of remove some of that delta on the way up. But for example, getting short strategy here, you would be, let's see, you're selling, you're selling a 175 call, you're buying a 175 put, right? You get about a short 100, negative 100 delta. It's equivalent to being short 100 shares. You're not borrowing anything from anyone, right? So you don't have to go out and locate your shares to short. So you're not paying interest on that. You're not responsible for any dividends. You're just responsible for the margin. And I'm just looking at what is the requirement, right? The initial margin requirement. This is, well, this is only 65 days, which means that, you know, if you're doing this on a shorter term time frame, you would have to continuously roll your position, but you'll probably find a little bit more liquidity in the near term options. If you go like 4 years out, I don't know how much demand for options and strategy that are 4 years out. I haven't looked, so that's why I don't know, but it's always good to check, right? So if you're short and at the money call, and then you're long and at the money put, right? You get about a $417 or $420 credit. You're short 100 shares, and it only takes, in the portfolio margin account, it only takes about $5,400, right? So most retail traders will say, I can get short strategy 100 shares of $178 dog with only 5,400 bucks. That's great, right? I could make a killing here because I can really size up on this trade. But if now we do a simple math, what if the stock goes to 300, right? Where it was back in November or October, whatever that was. Can it go there? Maybe, right? What's going to happen if the underlying is at 300? I'm seeing P&L is down, right? You're down on your P&L. This is just 100 shares at 300. I'm seeing P&L down about 12 grand, and margin requirement doubles. The problem is if we now take volatility a little bit higher, right? Because if, and this is how these things usually work. If strategy starts to ramp higher, remember you're short a 175 call, right? If it ramps higher, now the those that are short stock may want to cover. They don't want to go out and buy a bunch of stock because, you know, at 300, This is a relatively higher priced underlying. So the market participants will go out and reach for options because options are lower priced, so to speak, right? They're going to increase the implied volatility as the underlying is moving higher, right? So you would say, wait a minute. I thought that implied volatility only goes up when the underlying goes down. But in a short squeeze, and we see this happen in oil, we see this happen in volatility products, we see this happen in gold, silver now, right? Where the risk is actually to the upside when we are seeing a short squeeze. So when I said that at 300, this trade is down 12 grand, this is not accounting for any adjustments for implied volatility. And if we take volatility, I have no idea how much it's going to expand, but if we take volatility into account, right, your losses, right, from your delta exposure look in line, but I think that your margin, that's the problem, right? You're down 12 grand in your P&L. That's one thing. That sucks. That by itself is an issue. But your margin goes without adjustments for volatility, goes from 5,400 to about 10,000. But now your broker is going to say, oh, it's not 10,000. I need you to put up another 50. Right? We don't know that this is the kind of a known unknown. We know that margin is going to increase. We just don't know by how much. So if you didn't prepare that extra 50 that your broker may ask for, guess what they're going to do? They're going to liquidate your position at the worst possible time, locking in that $12,000 loss, not because you were wrong. Well, initially you kind of were, but if your idea plays out over the next, 3-4 years and, the stock goes to zero, but you got liquidated, not because you were wrong on the idea long term, but because you didn't have the buying power to cover your position to give you the chance to fight another day. Right. So that's why I started with the risk when we're talking about getting short, right? And that's where it ends. Risk, 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 risk is everything. We can make the case why shorting strategy here is a good idea. We can make the case why shorting strategy here is a terrible idea. And who's right and who's wrong, only time will tell. But one thing for sure, that if you don't plan for margin expansion, that is your risk. The biggest risk is running out of buying power. If you don't plan for it, and this applies to VXX shorts as well. If you don't plan for it, the trade is going to go bad, even if the idea is right over long periods of time. All right, so that's kind of like my thought about shorting strategy here. I would probably, if you wanted to short strategy here, I wouldn't go with a synthetic short like that. I would probably look at buying an in the money put. Right, this is not going to give you a negative 100 delta. Right, but buying an in the money put will cut off your upside risk above 240. You cannot lose more than what you're paying for this 240 put with 65 days until expiration. Sure, can you sell out of the money puts against your long in the money put to kind of work off your basis, because you are paying some time premium buying an in the money put, right? There is extrinsic value. Paying $520 worth of time, these 65 days are not free. They'll cost you $520. So you may need to figure out a way to remove or to recover your extrinsic that you're paying for this in the money put. Or or you can consider doing a something like if the skew works out. Let's see. You can possibly sell. Hang on, let me get rid of this. This is just one more idea, something that I would possibly consider if I wanted to get in front of this. You can possibly sell a call spread, 210, 240, right? I'm not sure about the width, but you can play around with the strikes to figure it out. You're getting a $490 credit. Well, we're not going to keep that credit. We're going to go out and leverage this credit. We're going to leverage the risk. We're taking on the risk of about, $2,500. We're going to go out and spend this $500 credit to buy some kind of a put spread to the downside, right? Maybe we'll buy what's currently priced in about 130 if we think it's going to go outside of the expected range. So maybe we'll buy a 140, buy a 140 put. And then if you don't want to have a debit at all, you say, you know what, I'm going to buy a 140 and sell a 120. All right, so now you are in a kind of a synthetic short, so to speak, but your risk is defined and so is your reward, right? You're short 20 shares of this strategy, right? Your risk is capped at about $2,800, right? If it goes above 240 and you do nothing about it, you're out 2,800 bucks. Your break even, you will make at least a penny or more as long as this strategy stays below 212 over the next 65 days. You're taking in a net credit of about $167. You can possibly measure this credit as your return on risk. What's your risk? $2,800. That's how much you have to put up with your broker. If you're going to make $170 or $180 on $2,800 worth of risk over 65 days, you can make the case that there's some business aspect to this if you're going to trade this every month or every 2 months or whatever. And if you're right, if this strategy goes down and goes outside of what is currently being priced in based on current implied volatility, say strategies at 120 at expiration, you'll make $2,100, almost a 100% return on risk. Right, so I would probably consider something like this before doing a synthetic short by shorting at the money call and buying it at the money put. All right, so hopefully this is something for you guys to think about. I know this might sound like very complicated or very advanced concept, and it kind of is, right? Because we have multiple things moving at the same time. The good thing is that the example I just brought up, all of these options are in the same expiration cycle, so you could possibly think about it, and it won't sound as confusing, but you could also spread them in all sorts of different expirations to bend the T plus zero any way that works best for you. Hopefully you got something out of this conversation. If you have any questions, we are out of time. I'm going to let you guys run, but you can find me on Discord, ask me whatever. We can talk about whatever. All questions are welcome. If you have topics that you'd like to discuss, they are all welcome on Discord. I'm going to catch you guys on Friday. Have a good day. Take care, everybody. Bye-bye.